Welcome, everyone. In today's explainer, we are mastering Dalal Street, or D Street as the veterans call it. We're going to completely unpack the blunt, no-nonsense intraday trading philosophy of one of India's most famous market analysts, Ashwani Gujral, pulling straight from his incredible book, How to Make Money in Intraday Trading. Now, if you've been trading for a while, you already know the market is a jungle. Random, undisciplined trades, they will get you absolutely slaughtered. So let's dive right into this and get you equipped.
This quote from our source material perfectly sets the tone for our entire session today. To forgive is divine, but D Street doesn't take this seriously. It never forgives. Man, that is some real, hardcore, tough love energy right there. But it's true. The market literally doesn't care about your hopes, your fears, or your prayers. It only respects discipline.
To survive and thrive out there, we need a Pukka trading plan. Today, we're going to walk chronologically through the exact lifespan of a successful intraday trade. We'll cover 1. Welcome to D Street. 2. Tactics for profitable entries. 3. Managing your active trades. 4. Exiting like a pro. 5. Surviving market traps. And finally, 6. Golden rules of capital. Now, all of this boils down to our source's 3 M's of survival: method, money management, and mindset. But today, we are focusing strictly on the hardcore method.
All right, Section 1. Welcome to D Street and the 3 M's of trading success.
Moving right along to Section 2, Tactics for Profitable Entries. This is all about timing your jump like a cheetah.
This brings us to the very first phase of the trade life cycle, right? Getting in at the precise right moment. As traders, we really have to be as fast as a cheetah and as sharp as a hawk. Which leads us to the golden question literally every novice trader asks while staring at the charts. So, when do we actually jump in, Yar? Well, the answer is you absolutely don't have to take the very first trade that comes your way. You have the choice to just sit on your hands. You only commit your capital when a majority of factors are aligned in your favor and the path ahead is crystal clear.
To filter out all that intraday noise, you've got to look for specific, precise setups. Let's break down the 4 key entry tactics in a trending market. Number 1, entering on a trend resumption after a correction hits a solid support or resistance level. Number 2, jumping in after a minor pullback midway through a strong trend. Number 3, entering on a sideways breakout right when the trend resumes. And number 4, entering when a rejection candle pops up at a crucial location after a retracement. Listen, if it doesn't fit one of these specific setups, you just don't trade.
Now, one of the most powerful concepts behind these entries is the contraction and eruption phase. Think of a sideways, super narrow market range as a contraction. It's basically the market taking a breather, resting, and coiling up like a giant spring. When that narrow range finally breaks, boom, it releases all that coiled up energy with incredible force. We call this the eruption phase. And guys, it is prime territory for a massive directional move.
Take a look at how this brilliantly plays out on a chart. See that contraction phase on the left? The price is moving in this incredibly tight range, forming what Gujral calls Lilliput, or extra small candles. Getting in the exact second that narrow range breaks gives you a huge follow-through, which you can see marked by that massive green volcanic eruption on the right. You keep a super tight stop loss based on that narrow range, which means your risk is incredibly small compared to the massive potential reward. It's a beautiful setup.
Let's switch gears to another entry tactic and see how we can capture momentum using trading gaps. Opening gaps clearly show built-up overnight emotion. So if the market opens with a gap in the direction of an already existing trend, an absolutely prime jugaad is to wait for an initial retracement to find support, say at the previous day's high or a key moving average, and enter the second the trend resumes. It's a fantastic way to just ride the coattails of the smart money.
Okay, Section 3. Managing your active trades. Nursing the live trade.
You see, getting into a trade is literally only half the battle. Now you actually have an active position, and you have to manage that trade like a hawk so you don't leave your hard-earned money on the table for the next guy. The absolutely crucial point here is how you handle your stop loss in a trending market. Your process needs to look like this. First, wait for the market to enter an expansion phase. Then, instead of just setting some fixed profit target that caps your gains, you trail your stop loss behind the trend. Finally, you just let the market kick you out when the trend eventually reverses. You never cap your gains. You just protect them as the stock runs higher and higher.
Here is a highly effective way to visualize this tactic, the 2 steps forward, 1 step back trailing method. Looking here, let's say you enter the trade at point 1. As those green candles march steadily upwards, you don't move your stop loss immediately under the current active candle. That's going to get you chopped out way too early. Instead, you keep it one step back, tucking it under the previous candle or a recent minor swing low. This strategically locks in your profits step by step while giving the trade just enough room to actually breathe.
Section 4. Exiting like a pro. Knowing exactly when to pack up your bags.
Of course, not every market lets you trail a stop-loss to infinity. Sometimes, you just have to know when the party's over. Greedy traders overstay their welcome and end up giving all their rupees right back to D Street. If you aren't exiting at a predetermined target, your chart will literally scream at you when it's time to go. Watch for these signals: a rejection candle right at a crucial support or resistance level, followed by confirmation of that rejection. Look for a narrowing range of candles, a tiring out of market momentum, or a really long top or bottom wick on a candle. When these appear, you book your profits and you walk away. Seriously, don't be greedy.
Section 5. Surviving market traps. The trappers and the trapped.
Look, even if you have perfect entries and exits, the market is completely full of booby traps and false breakouts designed by the big boys to steal your capital. I absolutely love this blunt tweet from the author. In the futures market, there are the trappers and the trapped. If you don't know which is you, chances are you are trapped. It's a stark, necessary reminder. If you are just holding on to an opinion, hoping and praying while the price action moves aggressively against you, you are the prey.
But check this out. Here is the master hack to turn the tables. Trap trading technique 1. When a breakout fails, let's say the market tries to push above a resistance level but immediately stalls and falls back. Amateur longs get trapped. Their stop losses get triggered, which causes a rapid, sharp price drop. A smart trader sees this failed breakout, immediately takes a trade in the opposite direction, and basically rides the wave of amateur panic for a massive, quick profit. You are literally profiting from their emotional frailty.
Which brings us to our final part, Section 6, Golden Rules of Capital. Preservation first, growth second. We've covered a ton of aggressive tactics today, but honestly, none of them mean a thing if you blow up your account. In this business, capital preservation always comes first, and capital growth comes second. I want to hit you with a serious reality check from the source material: 60%. Even with the best strategies in the absolute world, you generally do not have more than a 60% probability of success in any given trade. Let that sink in for a second. You will be wrong 4 out of 10 times. That is exactly why averaging down on losing trades is a total disaster and why strict stop losses are completely non-negotiable. The book cleverly uses this quote from the Bollywood film Dear Zindagi: "Genius is about knowing when to stop." It hits the nail on the head. If a trade is going against you, ditch it. Ditching a bad trade quickly instead of holding on and praying for a magical reversal is the absolute mark of a true trading genius. Keep your losses small so you can actually survive to trade again tomorrow.
So I'll leave you with this final, provocative question to think about. The next time you are staring down a bleeding red screen, are you going to stick to the wrong trade, or are you going to stick to the right strategy? Respect the market, follow the disciplined life cycle we just laid out, and never, ever let your emotions dictate your exits. Thanks for joining us for this explainer on Mastering D Street.